Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
The put side of the trade. We'll run through that. Try to come up with questions on that. Once again, clearly, on back for net short options, we still have substantial risk exposure with limited reward. You want to try to execute this. It needs a strong, neutral, slight bearish outlook. We want the underlying to go low to the lower strike stop. We want decreasing volatility and range-bound underlying price. All right. We get a little bit of a trend to upward. Once again, 1 to 2, 2 to 3 is an income trade. Whenever we're doing these ratio spreads, we're looking at doing that as income trade. The maximum risk in the trade established for net debit. Net debit date, if it goes up, and that's currency. Take that one out of there. Substantial but limited net debit underlying go down. This comes back to what I said just a minute ago. Substantial, limited to lower strike plus the net debit. We got to get out the yellow pad, the pencil, and we've got to work through these. You've got to spend some time doing these. I got it. If it does, if you're able to do that, thank goodness. On these, the maximum reward where we're looking at. It's established for the debit, it's the difference between the strike minus that debit, it's established for the credit, it's the difference between the strike plus the credit on that. We have limited potential for both, spreads established for both net debit or credit. Time decay is helpful to network, so it erodes the value of the first option, not so good. But also takes down the two options sold as well, so it's good. So it's kind of, it's really not that great, but it's better this way than that way. Kind of a little better on that. So as I said, these are a little bit different to kind of understand. How can time decay be helpful to me? Because I've got a long option that hurt. You got two sold options, so you want it to go away. Volatility, want to go low. Increasing implied volatility. Once again, let's just flip out of that time decay. Value of the long option is good, but the increased value of the whole options makes those go to negative territory, so that's not so good. You don't want that implied volatility. Once again, any of the ratio spreads, back to back spreads, ratio spreads, we want to do a small time window as possible. We have a net credit as an advantage. If it remains range bound, it ends exactly at the lower strike. It's going to be profitable. It really allows you to purchase with that money or a bit out of the money for less than full price. So you're reducing the cost of putting that on put on. It's substantial risk of time. Risk is in the underlying, and it's a complicated trade for the average trader. I fully endorse alternative trades being considered. Doesn't mean you shouldn't look at this trade. You shouldn't add it to your own. Just look at the alternatives ahead of time as you're looking at doing one of these trades. And we have. And this graph is with the net credit done on it. We should look at that. We'll move on to question.
All right, looks like we have a few questions actually in mail. If you want to go out.
Let me just say here, should we let the credit spread expire, or should we close the position, which happen more often? I don't know if we keep any statistics on that type of thing. My intuitive answer would be that I would let the option spread expire and keep the money. Reason for that would be because if I close out this position, I will encounter a fee to exit, which would cut into it. On the other hand, it could make an argument if you want to close out very close to the expiration date, just to take away any chance of anything abnormal happening in that week. So hopefully it wouldn't cost that much to take the trade off the table anyway from that. And let's see, weighted answers. We're talking about FX options can be put and sold anytime. Absolutely. As I said, trading hour 7:30 in the morning to 4:15 in the afternoon to allow you to kind of play along with a lot of the stock market tons from overseas. Remembering that FX spot trades basically 24 hours a day, 6 days a week, if you will. So as long as the market's open, you can get out. And the pricing will be there. That's the option. Exchange traded option across the board is that the price is available to you at any time. Again, the market has to be open, and you do have for the option. And also, a way to ask, what kind of risk demand do you reckon? In this case, we're talking about these spreads in particular. I think we've outlined a couple of those areas of looking at support or resistance levels for that particular underlying, making decisions and setting that's going to be my stop point. I'm going to close out. It's going in the, if you hit the resistance line or you hit the support line, in the opposite direction that you're looking spread to go. I think the other stuff you have to do is you have to set your trading plan and look perhaps at you wouldn't want to exit. I mentioned before, because the back spreads are longer time frames, that they're going to be a little harder to manage in the sense that your underlying isn't making you anticipate. You are encountering time decay, and you have to make some decision somewhere along the line of where to end that. And that's up to you. That's your risk tolerance for each and every one of you. You say, okay, this underlying isn't performing the way I anticipated. I will change my opinion. I will exit the trade and live a gun again to trade another day. Or you could say, no, I still think side C stays in place, hold on up, we're going to let it go from that direction. Okay. Stock traders, what the underlying for the part you can look at, you need to go right on the FX options site for the ISE, and you go right on there. I'm not exactly sure what they do have charts for the dollar exchange rate, the Swiss franc, the dollar, all the currency. And they would be the charts you would use. That is your underlying. Dollar versus the British pound, dollar versus the Swedish krona. They are the charts you would use to chart the underlying. As you would in options trade, where you would go look at the chart of Apple or the chart of an index like the S&P. Okay, so that's where you would go. We've got a couple of interesting ones. How about a put as well as a call rate? I'd have to sit down and get that pad out on that one to work through on that. I'd be interested to see your thought process on it there. Great question, and I'll be honest with you. So I sat down and sketched these out. I'm not altogether sure. Try to ways to asking in a quick ratio spread to be wide, and using SG options as an example, so the 11 quick, but like 60, and 1,000. This type of trade done in FX well. Once again, because of the way the FX moves, it's definitely moving towards 4 decimal points. You're not getting a larger a larger move. Notwithstanding the fact that if you're at 153, 54, and you go from 133, 54 to 154, that is a substantial move in FX. It is certainly not the same kind of move you see in the S&P, and you don't see that kind of substantial move off. Once again, you'll see the day like that over a longer period of time. It kind of stands up out. So in the case of this, and this is what I kind of explained a little bit up front there, when you're looking at these strike prices, because they're half-point strikes, the 154, the 154.5, 155, it is going to take a little bit more work to kind of look and see the pricing on these, where you could do it to get the spread set up for credit for you on that side. And you may have to move out a little bit in either direction, understanding that the prices are close together.
We have time maybe for one more question.
Okay. Let's see here. Bob's asking, can I put ratio puts my break-even level? I can stop every day to account. Okay. Couple of things with that. Number one, the real answer there lies if you allow to enter that trade and monitor that for you. Most of the brokers are very consistent, and that certainly is the way do that. Once again, one of the advantages we have, as opposed to a stock stop is the fact that you have an opportunity for the movement to occur in and out of your levels and not get stopped out. If you put that in there, it's taking you out of the trade. And you set it up for your break even. So if you get an intraday movement of the underlying, which can happen, it's substantial. Stop you out of the trade. The same thing might happen if you FX. Put that in there to protect yourself, because SFX doesn't have if you get caught and don't have a stop in at the level, your loss could really be substantial for some person today. You could get stopped out by your broker. That's probably not going to happen in the opposite. But if you put that stop in there, you run the risk of getting stopped out and then finding out at the end of the day. It's tough, because that's another way to be able to have a stop out by your. You may be taking a little bit of a loss. Stay within the ability for it to come back for you. So that's about it. I think that's all the time we have right now.
Right. I think we're all set then. Well, thanks very much, Elle, for joining us. Thanks to all of you.
Everyone.
Thank you. If you'd like to learn more about the ISE FX Options, make sure to visit www.fxoptions.com. We'll be able to see the full list of currency pairs that Al showed earlier. We do hope to see you all at our upcoming webinar. If you're going to sign up, make sure to visit isecom.com/webinars. You'll be able to check out our latest schedule. We do hope to see you all back next week. We will be having a live session with Steve Missick. Thanks again, guys. See you next time. Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.